Well, we had a big test for Spain this morning as it put its toe into the bond market for the first time since the European Central Bank pledged its support through unlimited bond purchases to help reduce Spain's borrowing costs. Big catch, though, with respect to that support, and that's, of course, that Spain has to apply for a full bailout from the European Union before the ECB is going to get involved. So did the pledge help? Kind of. Yields fell in the two auctions that were conducted earlier this morning. They were for 12 and 18-month Treasury bills, so the borrowing costs were reduced to some degree. But demand was relatively tepid, and that has to concern people inside the Spanish government and indeed investors around the European Union. My suspicion is that the demand was crimped a little bit by data from the Bank of Spain this morning, which showed that bad debts in Spain's beleaguered banking sector rose to a record 9.9% of overall portfolios. That means that the banks might need more than the 60 billion euros in capital that the market is betting on when the Spanish bank audit is reported on the 28th of September. Of course, there's a small matter as well of the Moody's Investor Service review of Spain's investment grade credit rating, and of course some regional elections next month as well. So there's a lot of event risk for Spain, and I think that may have kept a lot of investors on the sidelines. Nonetheless, the yields did fall, and that can't be discounted. Right now, investors are waiting to see whether Spain will accept that full EU bailout and the conditionality that goes along with it in order to get the ECB support, or whether it feels that verbal intervention alone is enough to drive Spain into next year as it tries to wrestle some of its budget constraints. It's all to play for, of course, and we're going to watch it intently right here at the ibtimes.co.uk.